Welcome back to the Sound Financial Group podcast. I am Paul Adams, founder of Sound Financial Group. I am not joined by Mr. Shepard today because we're on part 2 of our Dave Ramsey Not Understanding Whole Life Insurance, one of the most basic building blocks of a person's financial affairs, life insurance, and not understanding some of the most basic components of this tool that people use every day to take better care of their future finances. So, we are going to jump right in, but I need your help, Sound Financial family. I need all of you to get in here, hit these comments, share this episode. Dave Ramsey is way worse in the second half of this same video than the first half. And what I mean by that is being dead wrong. So we're going to jump right in. I hope you guys enjoy this. Buckle up. I may get a little heated. I try to get a lot of my thoughts out ahead of time, and we will see if I get triggered. Here we go. Dave, let us have it.
Well, he's going to have that anyway.
No, instead of putting it into this ripoff thing and making 4% on your money, and when he dies, he loses his cash value.
Let's pause right there for a moment. This ripoff thing that gets you 4%. Again, if it is a ripoff, then is the bank leaving cash in the bank at 0.5% for the last 20 years until interest rates recently went up, Dave? Was that all ripoff because it was a low rate of return?
If you had put this in a good mutual fund, you'd have 100x, 10x the amount.
Okay, let's jump into that really quick. You might have 100x. You might have 10x. You might have, the difference between 10x and 100x, Dave, is huge. Let's get back to Dave here.
Amount of money, and that's your infinite freaking bank.
But we're only putting in 70,000, and he's going to be.
That's how present value formula works in finance.
Look,
let me just take the same.
I mean, I understand.
Let's intellectually deal with this for a second, okay?
We're going to intellectually deal with it. Like it hasn't been emotional as you've been condescending to this man the entire time, Dave.
Take the same amount of money when you get off the air and put it in a financial calculator at 11% and pretend it was invested in mutual funds and see what it is when he's 88 years old.
It'll be more.
A whole lot more.
And he'll have that too. But this, to me, is a way to...
No, he doesn't have that too.
Okay, let's take a quick look at what Dave said there about how much money you would have. Let's follow Mr. Ramsey's basic premise here. So on the left-hand side, what I've done to mimic this person's investment that they're talking about is $5,373 a year at 11% for 13 years. Then we're not investing anymore. We're just letting it compound now at 11%. No taxes due, Dave. We're just going to get 11% in our Good Growth Mutual Fund, and we're never going to be taxed on it. That would grow uninterrupted. That's 11% smoothing up to the right. So in Dave's universe, there is no volatility. There never is a down year. There was never a down year while we were accumulating, nor was there ever a down year during the entire accumulation. By the way, the only way conceivable 11% would happen, by the way, never tax-free, but the only way it would possibly happen if you were 100% equities portfolio, like all stocks. It's the only chance. And what he's comparing it to as if it's outstripping it is an account that is looked at by the Financial Planning Board as safe as CDs at a bank. So he's saying it's going to get to 92 million. That is a lie. Now, I'm going to call Dave out on a few things here where he is intentionally giving somebody a mistruth. If I, as somebody has a great deal of understanding about finance, intentionally leave somebody under an impression of inaccurate information, especially inaccurate to the tune of nearly $100 million, I would be liable for that. Dave is not liable because he's not licensed. He's not regulated by any of this. He is absolved by the disclosure at the end of his show. What might really more likely happen is, let's say, an 8% rate of return over time in an academically allocated, globally diversified portfolio, and then assuming that that account just had to pay its own taxes during all of accumulation, and it's held by somebody who has a relatively high income and therefore high income tax and higher capital gains tax. That would grow the entire time to 6.2 million. That is a good chunk of money. There is no question. But you're blowing up what this guy did for his son with an incredibly safe investment by instead saying he should push the throttle all the way on to absolutely the most aggressive possible outcome, not include taxes, and then compare that to the safe tool and say, see how much better it is. That is misleading the public, Dave. That is you misleading your own listener. You guys ready? We're going to go back to it here.
Borrow against.
That's called opportunity cost on your money. You put it into something that's going to make him at 88 have $2.5 million, and he should have had $25 million.
Okay, guys. I mean, what a great example. Again, he is literally just making up numbers. Might have 10 times as much, might have 100 times as much. It is a commitment to entertain the people that are listening with zero commitment whatsoever of giving appropriate financial advice to the person calling into a show or creating any level of real understanding, as all he does is talks down to and belittles the guy who called in.
Because you screwed up and put it in the wrong thing.
Well, when we screwed up and put it in real estate too, and he's going to get real estate.
Well, then put the money in real estate, but don't put it in this crap.
Like, you can get a sense of how totally either or Dave Ramsey is. Like, you either do this or you do that. And you definitely don't do anything that he doesn't recommend, or you're going to get absolutely talked down to on his show. So that he doesn't, like, many people don't want to have an actual discussion of disagreements, especially around money. Just having a conversation of this is what the outcomes are going to be and the interest rate or the tax rates, and showing somebody instead just saying flippantly it's 10 to 100 times more or 25 million. He has no idea what any of the outcomes would be, and no commitment to even giving accurate information to his own listeners.
I have to respectfully disagree.
Well, on what basis? He's getting more money if you put it somewhere else.
I just got to say, the guy who called in, if anybody knows Jim in Nashville, this guy is a saint. I would have a difficult time letting somebody talk to me this way and then respectfully disagree with them.
But he's able to borrow against this.
If you've got $25 million in mutual funds, you can borrow against it.
Now, I want you guys to remember that. He just said, if you have $25 million in mutual funds, you can borrow against it. And he just said that will be better than doing the life insurance. Now, it is very different, but it doesn't mean that it always works. And that volatility component is a big deal. And again, none of us over here at Sound Financial Group or on this podcast are either or. Real estate, great. Investments in the market, great. Whole life insurance, great. But they should all be examined and coordinated together for the maximum outcome, as opposed to it's just a terrible tool and you're an idiot for even considering it.
But he's going to have to wait until he's retired to get that amount of money.
Okay, so you're going to teach him that the way he becomes wealthy is borrowing against money that his father invested for him. That's how he builds wealth.
Now, just a second ago, he told this caller that all of these investments in this mutual fund that you're creating for your son, that can be his infinite bank. But now, rather than doing that, he is poo-pooing the idea of interfamily financing, which we've seen in our business create tremendous outcomes for people, multi-generational legacies, because somebody had the opportunity to borrow from a parent to start that company that then launched them to a level of success they might not have ever seen otherwise. Yeah, Dave, that's a terrible idea.
Said no one rich ever.
I mean, banks use this product to...
No, they do not.
Okay, guys, in just a moment, I want you guys to see how adamant Dave Ramsey is about how banks absolutely don't use whole life insurance.
I've been watching too much TikTok. Banks do not use whole life. Not ever.
Banks do not use whole life. Not ever. That's what he just said. Banks do not use whole life. Not ever. Let's hear it again.
banks use this product to.
No, they do not. You've been watching too much TikTok. Banks do not use whole life. Not ever. Banks nowhere, no banks sell.
I would respectfully disagree.
No, they don't. They do not use whole life insurance.
What bank?
Well, we Google it and see what typically banks do with their money, but I believe
typically banks never put money. Let me tell you what banks do. They put it in bonds. They're required to. They wouldn't be allowed by federal regulations to put it in whole life. It's not a place to invest money because it.
Now, by the way, I want you guys to notice that guy just went, like, oh, maybe I wasn't told the truth. Maybe banks don't own a whole life insurance. And that was the premise I built this entire decision on. And now here's Dave Ramsey telling me it's just not true. Can you guys see this part of my hair? This is terrible. I got to fix that. For those of you listening on the podcast, I have some seriously errant hairs underneath my headphones, but it's fixed now. So Dave is dead freaking wrong on this. He is lying to everybody out there. Now, whether it is a sin of commission or a sin of omission, I care not. I care that this guy is absolutely damaging everybody listening to his show.
Investment.
I pounded my desk so hard that the video started again. But let me show you how unbelievably full of snot this guy is. So let's start with Schedule RCF. This is a tool that is used by the FDIC to be able to, life insurance. And it gives exactly how to account for it on a bank's balance sheet. Oh, there's more. We also have this post from the FDIC, bank-owned life insurance, interagency statement on the purchase and risk management of life insurance owned by banks. What else do we have? This is another one of those PDFs we can get that just walks through exactly how to record it on a bank's balance sheet from the FDIC. We also have this whole section from the Office of the Comptroller of the Currency in the way that banks own life insurance. We have bank-owned life insurance, the interagency statement on the purchase and risk management of life insurance. What is bank-owned life insurance and how does it work from Investopedia? There is an acronym for it, Dave. It's called BOLI, bank-owned life insurance. We also have, total banks with over 50 plus billion have 45 total banks that are in that category. 36 of them have BOLI. That's 80%. As you look down this, how is that in assets? $439 billion, of which $3.7 billion is the cash surrender value of their whole life insurance. We can go right down the list here, Dave. This is going to show that many, 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 many banks have a truckload of money in whole life insurance. And I found another FDIC component. Not only are they allowed to do it, but it's considered tier 1 capital on their balance sheet. I should probably zoom in and let you guys have a shot at seeing that better. But it's tier 1 capital. It means it counts as the highest reservable, safest capital a bank can have. They can even go above 25% as long as they have a bank committee that's done the research so they're not taking too much risk going above 25%. But Dave, you are wrong. You are telling the American public a total, it's just not true. It's not true. And you're making this man, Jim, question the decision of what he did for his son based upon you telling him something that is completely untrue. All right. I had to get that off my chest. I think I'm feeling better now. Let's finish out.
The rate of return 4%. Sucks. And when you die, you lose your cash value.
I know.
We discussed that in part 1. Also, totally not true. It is a straw man. It's because the cash value matures into the death benefit the day you die. So you could say, you get way more than your cash value at death. You get the death benefit would be another way to say it. But instead, Dave Ramsey, rather than having a decent discussion, would rather live inside this straw man fallacy.
But you also, you're making it sound like I'm losing money on the whole.
You're leaving money on the table.
You're making it sound like when, not me, but my son, when he dies, that he's only going to be able to get
He's going to have $22 million less than he should have if you had put this in a good investment.
you had mentioned that the cash value dies and you only get the face value. That's
Correct.
not true.
That is true.
That's not.
I just covered that with you for the last 10 minutes. Paid up additions are the only way that
Jim from Tennessee, if you're listening, you are correct. Dave Ramsey is not correct. Dave Ramsey is pulling a fallacy on you in a straw man argument against whole life insurance.
cash value increases unless you're using a universal life program B where you pay extra to get the extra insurance, which is another form of paid up additions.
That isn't coming out.
Which incidentally, option B of a universal life policy is nothing like paid up additions of a whole life policy, because a universal life policy, if you look back to some of our old episodes where we talk about the different types of life insurance, it is overfunded term insurance. We're taking term insurance internal to contract, term insurance costs, and then you're creating a little side fund inside the life insurance. It is the definition of term insurance, not paid up additions. It just speaks to how little he understands, but how confidently he's willing to express his non-truths to his listeners.
Out of my pocket, though, I put $70,000.
It is coming out of your pocket.
It's coming out of the policy's pocket.
I know. The policy, you put the money in, dude. And then it paid you a dividend, and you chose to buy more of this crap with the dividend, and you're calling that I kept my cash value. No, you...
Now, Dave Ramsey would never use this argument on your mutual fund growth and compounding, right? He's never going to say to you that you keep putting in more money because I'm compounding at 11% forever. Well, then isn't that compounding putting in more money? Hey, Dave, how about all the taxes I had to pay out of another pocket? How about the first time it got to 10 million and then I got an 11% rate of return and I had a $1.1 million gain and I had to pay $300,000 in taxes? Where did I get that money from, Dave? Like, you can see, this is that fallacy. My son, who we homeschool, but has a book in rational arguments and rhetoric in identifying fallacies, he's 13 and can watch this and understand that Dave is just setting up fallacy after fallacy after fallacy rather than, and by the way, there can be good reasons to not own whole life insurance, okay? Totally good reasons to not own it in certain people's situations. And we oftentimes will have situations where it's not recommended because of that, or people have it and we recommend that they modify it because maybe it wasn't appropriate for them. There are legitimate reasons why they could be backed up by math and scholarship and don't require that you talk down to somebody. Dave Ramsey is scaring people away from getting competent financial help because he craps on them every time they reach into his show, try to ask a question or try to disagree.
Well, I know that I put in $70,000 and at a certain age, it's going to be at age when he's 15 years old, that's going to be paid up.
Yeah, Jim, and you understand what paid up is? You understand if you're alive that there's a probability of your death. And so 100% of the time that a life insurance program is paid up, it means that you prepaid it. That's all.
Now, are you guys going to be shocked to find out that Dave Ramsey is also totally wrong here? Because a paid up policy can also be a policy you've just kept for years. You had no intention of stopping paying on, and you decided at that time, I want to pay it up. You didn't overpay. You just paid the appropriate amount for the amount of coverage you now get to keep without any paying any more future premiums.
What it means. Because as long as there's a probability of death, there's a cost. So the insurance company has always got a cost as long as you're alive. So there is no such thing as a paid up. That's an industry term that gets suckers like you. That's what it is.
Now, I think the way that he ends that is such a great thing. They just ends it with suckers like you. Like, why, Dave? Why? If it's not about just getting ratings, if it's not about people who just agree with you and love to see you crap on somebody, why? I think it's because you do this kind of thing because you know if you went toe-to-toe with somebody that knew their math, if you guys had actual future value calculators and you did a side-by-side comparison, here's the thing. I'm not saying maybe for this kid that this guy is talking about, maybe he would have been better off in your strategy. But you know what you're not doing? You're not putting it up to the test of math. You're not putting it up to the test of scholarship. You don't even check your answers. You present falsehoods with a level of confidence I have never seen from another human being. And for that is the reason why, at least for the people in the Sound Financial family that listen to this podcast, they will know. They will know how inaccurate you are. They will know how to think about this garbage when they see it on the internet. They will know that you are perfectly willing to be totally, totally wrong and yet present your wrong answer with a level of confidence that would never let anybody know that you could do that. And this goes for your co-host too, because she could be, I don't know her name, but she could have been Googling this while you were spouting falsehoods, put her hand on your shoulder and said, hey, actually they do. This is how that works. And this has been brought up to him before. It's not as if he hasn't had the opportunity to fix it. There is no fixing it because it disagrees with the decision he made 20 years ago that it's a bad idea to own whole life insurance. Just ask him about any idea ask him to justify why he says 12% rate of return. You guys can look that up on some of our old episodes. It is also totally inaccurate, untrue, and unattainable by the regular person. So with that, here's what I want to ask all of you to like this video. We got to get this out. People need to know how inaccurate one of the largest financial voices in this country is. Second, watch for these clips and like them and share them. We'll make them bite-sized and awesome from this episode. You'll see those coming out in the next couple of weeks. And last but not least, comment below. Which one of the things said here today, either by me or by Dave, got the greatest amount of attention for you? And then if you see some other comments you like those too. It really makes a difference. And especially for something like this, we got to get it in front of as many people as possible so that it's not just the Sound Financial family that's getting the chance to make better financial decisions and see through these falsehoods. We need to get it out to everybody else. And we hope that this episode has been a contribution to you being able to design and build a good life.